You're on the air with the Mortgage Man, Drew Stevens on AM 1160.
Well, good afternoon. It's Drew Stevens, the Mortgage Man. Residential Plus Mortgage. www.drewthemortgageman.com. Today I have a very lovely lady named Cindy Banks with me today, and she is a realtor with RE/MAX, right?
Yes.
Right, glad. She actually has some experience. Many years ago you did this, right?
Over 25 years ago.
That's okay. Your voice is about the same, isn't it? Though,
Thank
anyway?
you. Yes, thank you.
I sound like a little. Do I kind of sound like a little kid? I'm 52, but I sound kind of young. Is that good or bad, John? What do you think? Is it good? All right, that's all right. So you sound great.
Thank you.
But we're going to talk about a lot of different stuff today. Great, exciting 4th of July weekend coming up. You want to call anytime, that'd be great. 847-227-5533 is my phone, or my cell, which is 630-915-5706. And the website is www.drewthemortgageman.com. Cindy is over. She's got a really cool website. Or is that an email address? Cindy at cindybanks.com. So CINDY at CINDYBANKS.com.
Right.
Is there a website also?
Website cindybanks.com.
Right, cindybanks.com. And you can also, I want you to do this, because the way that I kind of ran into Cindy when I was coming home from a really late night baseball game. And it was by North Avenue and 59 in St. Charles?
Actually, West Chicago.
That's West Chicago?
Mm-hmm.
Yeah, of course, that's right. And there is this massive billboard. It was the largest billboard I've ever seen in my entire life. And I pulled over. I go, oh my God, that was a big billboard. So I turned around and went back in. There's a hot dog stand there. What's it called again?
It's called Scooby's.
Scooby-Dooby. And I go, wow, man, I got to call that lady. So I wrote her down and give her a call. So that is why she's here today. So she's going to talk about the kind of where the real estate markets are going right now, and a little bit on short sales and what you should do if you find yourself kind of getting in trouble. And we'll talk some more about interest rates and about the markets in general. Sounds good to you?
Yep. Sounds great.
Just briefly on rates, they're fantastic still. They did spike up a little bit this past week. There was the bond market had a little bit of weakness in it, but rates are maybe 1/8 of a point higher. I just closed a buddy of mine at 2 7/8. But the only reason he was 2 7/8 is because he's doing cash out. So normally it would have been 2.75 on a 7-year ARM. So right now it is the flat 0-point rate on a 7-year ARM is around 2.75. Your 5-year ARM is 2.5. 15 is 3.625, and your 30 is 4.375. Now, yesterday I did an application, and I had a husband and a wife, and I showed them the math of why they should do the 7-year ARM. But still, there's fear because of adjustables. So they're kind of debating with it, but you should look into this. A lot of my customers who are financial planners and CPAs, they take the ARM all day. So what I did was I took the math. I took their payment at a 15-year fixed, compared to keeping the same payment if they took the 7-year ARM. So even if the rate went to the worst thing you could possibly do after 7 years, they would still basically not lose money because you've paid so much more to principal in that 7-year period. It's just phenomenal the way the math works. So they're still thinking about whether to do the ARM or to the adjustable, the fixed. But there's many ways of looking at this. The whole point is that term and the control of principal is up to you. It's not up to the lender. It's up to you and how you want to make your payments. Purchases, what do you think right now? How are purchases going for you lately? Are you seeing an upturn or an uptick, or what are you seeing right now?
Well, historically, the spring market is strong,
okay,
and we're not into summer yet, almost.
Yeah.
Well, we just actually turned into summer, I guess, on the 22nd or
right,
21st, technically. But the market itself is strong. A lot of first-time buyers, a lot of downsizers. Mm-hmm. People that have been in larger homes looking to downsize into smaller, more manageable properties.
That's hard now, isn't it, though?
Well, it can be, but a lot of these clients already have paid off their properties if they've been there 15, 20 years.
Yeah, good point. Okay.
So they're taking an adjustment, not selling as high at the high side of the market as they might have expected maybe 5 years ago or so, but they have enough within their property to downsize easily and put some money away.
Absolutely. That's interesting because for the most part, for most of my guests who've been on, we've talked about the opposite, which is you're in this house now. Yeah, it's depressing. You've lost equity. But the larger home lost more equity. So in essence, theoretically, if you have a $300,000 home that used to be worth $400 and you owe $200, you're still going to get out of it with maybe, say, $80,000 or whatever it is. So you have this down payment that's large, and you're looking at a home that used to be $700 that's now $450 or something.
Right.
So it's just the larger property went at a huge percentage decrease. The worry I was thinking about what your idea with the downside would be what if a person had a mortgage, so they couldn't get out of that one.
Right.
They can't downsize anyway. So that's where oftentimes they can come to you for help on the short sale side. So we were talking a little bit about that before we went into the start of the show. Before we get into that, please, any questions or problems or comments, please give us a call. Again, 847-227-5533. Again, 847-227-5533. Or my cell of 630-915-5706. When you go into this short sale paradigm, what do you find is the usual situation? Is it too late, or is it? Are you glad they came to you when they did? How does it usually happen for you when it does happen?
Well, a couple of things. Since I've been in the business over 25 years, I have a lot of clients that look for great real estate advice, and they can do that online at cindybanks.com. Of course, they can call me as well. And if they tend to feel that they're going to get in trouble, not going to be able to pay a mortgage payment, oftentimes they'll call me ahead of that happening. And that's really the key to do a successful short sale, is if you know you're going to be in trouble, you've lost a job, or you are going to lose a job, or you have a loved one, a family member that's not, going to make it, so you're going to have one income. There's all these different dynamics that can happen to change your financial status. You really need to get us involved ahead of that. Oftentimes people call just generically after they're already in trouble. Maybe they've not made a mortgage payment for 2, 3, 4 months. This is a big challenge. The bank that you're with, or the 2 mortgages that you might have, a first and a second, they really need a little advance notice. They will work with you if you're able to give them advance notice. They will give you advice. They have helplines. And again, we have ways to contact them as well to support the process. And your dynamic might change. Your finances might change. You might get another job. Lots of things can happen. But we can definitely give advice. And then certain advice you would need to get different professionals, obviously attorneys, tax accountants, things like this. But from the real estate side and trying to help you with the process, please, let us know and we can start it.
You mentioned before that oftentimes you have to prove a hardship. Correct. How does that occur? What do they ask? What kind of when is it ever denied because of a lack of hardship?
Absolutely.
Really? What's a lack of hardship?
Well, you have money in the bank.
Okay. But is it, is it, what about IRAs counted against you, or are they not, or how do they generally handle the IRA situation?
Remember, there's a lot of banks out there.
Okay.
Your local bank may work with you differently than a large institution. So everybody has different rules. But a hardship has to be proven. Again, you can't have money stashed away. You can't, they're going to ask for your financials. They're going to ask for everything relevant to finances to prove that you can or cannot pay. Maybe you don't want to pay. Maybe you bought a boat.
Right.
Maybe you have 2 or 3 other properties. Maybe you're an investor. There's different situations where they will not count it and they will still ask you to perform.
Sure.
So hardship would be, again, loss of an income, loss of a job, loss of a spouse, medical. Definitely medical comes in there. So if you have less money coming in than you can push out for bills and mortgage payments, they will take all of that into account. And the big challenge is when the market was very strong 5-6 years ago and everyone refinanced and took money out of their product because the market was moving up so quickly, they had that equity and they did other things with it. Maybe bought more property, bought a second car, third car, whatever they did. Then the market dropped so dramatically that it absorbed that second mortgage, for example. And now, you can't sell your home for what it's worth, but more importantly, you can't cover that mortgage.
Right. Well, I think, but if there's a space, I guess, in between the time that you try the short sale or if you're really desperate, make sure you call me first because we can maybe work with this because I was talking to you about this before. By the way, if you can, please get your pens and papers out for the second half of the show. We're going to talk a little bit about some financial planning with financialfulfillment.com, our sister company. But what I was getting to is, and this is going in with some of our mailers also that we send out, and but we kind of talk about not only on the show but on the website. The program called DU Streamline and Open Access are still around. These programs, I should say. And one is for Fannie Mae, one is for Freddie Mac, which are basically just investors. So you might have a mortgage with Wells Fargo or Chase or whatever. It doesn't mean they own the note. The note is generally owned by an investor, such as Fannie Mae or Freddie Mac. And if the home you feel is going to underappraise, just call anyway. There's a couple things. You might get an appraisal waiver. You might get a situation where you have to have an appraisal, but they will do the deal as long as you're at 125% of the value. Example, let's say you owe $100,000. More realistic. Let's take $200,000. Let's say you owe $200,000. Okay, so you take $200,000 and divide that by 1.25. So $200,000, 1.25. So as long as the house appraises for 160, you're going to be okay on this program. If you have a second mortgage, don't worry about it. They generally have what they call an unlimited CLTV, which is combined loan to value. So make sure you ask about these programs. Again, they call it Open Access and DU Streamline. If you have an FHA loan, also same situation. We can sometimes get that appraisal waived. Things are different. They're not as easy as they used to be, but still the FHAs are a very viable product also. And the second half of the show, as I said before, we're going to talk more about a little bit about financial planning and some more about reverse mortgages. We also want to talk about, which is also a method of combating that fear of loss of equity if you're over 62 years of age. And don't worry, by the way, about these things going away. They're not going away. I know that Wells Fargo got out of them, but don't worry about it. So give me a call, 847-227-5533 or 630-915-5706. Back a couple seconds with Cindy Banks and cindybanks.com. www.cindybanks.com. All right?